Joining me now, Burton Malkiel is a professor emeritus of economics at Princeton and author of A Random Walk Down Wall Street, which is celebrating its 50th anniversary. So, Professor Burton Malkiel, first of all, it's been a while. It's a pleasure. Thank you for coming on the show.
It's a pleasure to see you again, Larry.
So let's start with your excellent piece in the Wall Street Journal today. We're talking about bad economic policies. And your point is Biden's stock buyback tax would hit the little guy. And it would do so because the so-called little guy, middle-income folks, indirectly own stocks through 401ks, IRAs, state pension funds, and the like. So what is the logic in taxing the stock buyback?
Well, I think that's exactly the problem, Larry, that, the idea is, well, very few poor people actually own stock directly. And so the thought is that, gee, if we do something like this, we're only going to be getting the top 1%. And I think what people don't realize is that, sure, poor people don't own a lot of stock directly. They own very little. But most of us own stock indirectly through our 401k, or in my case, a 403b for educational institutions. The union pension funds own enormous amounts of stock. CalPERS, one of the largest institutional investors in the country, owns a lot of stock. And what people don't realize is that these are the people who are going to be hurt. It's all the mutual funds that we all own that own a lot of stock. And the other thing that's just wrong about this is the idea that, gee, if there's a stock buyback, the money just gets lost. It just goes into the pockets of rich people. In fact, it almost all goes back into the system. And it goes back into the system in a particularly efficient way because companies buy back their stock when they don't have good investment opportunities. And by giving the money back in buybacks, that money flows back into the stock market in newer companies, in entrepreneurial companies, and it's exactly the kind of thing that you want from a capitalist system.
Yes, it is. Bert, let's go back, random walk down Wall Street. The hypothesis there, I mean, I think it's as good today as it ever was. Passive investing, buying the S&P index, exchange-traded funds, it's very cheap to do so now. They will outperform active managers, and therefore people should invest for the long term. I mean, tell me if I'm being correct. I once interviewed you, actually several times interviewed you on another show, on another network, where we talked about that years back. But here we go again. Better not to do short-term investing. I think that's one of the key points. Tell me about it.
No, absolutely. And in fact, the idea that you will be better off simply buying and holding a broad-based index fund is something I believed in even before there were index funds. When I first wrote the book, I suggested that people ought to have index funds, and in fact, index funds didn't exist till 3 years later. I believe in this, Larry, even more than I did 50 years ago, because the data are very, very clear that year after year, about 2/3 of active managers are beaten by an index investor. And the 1/3 that win in one year aren't the same people as win in the next year. So that when you compound this over 10 or 20 years, you're talking about 90% of people who go active are underperforming an index investor. Now, I'm not saying that nobody can beat the market. There are people who can do it. But when you try to do that, you're much more likely to be in the 90% of the distribution that does worse, rather than the 10% that does better. And so I say at least the core of everybody's portfolio ought to be invested in broad-based index funds. And frankly, even better than the S&P 500, I would do a total stock market fund.
Oh.
I want you to also have the small entrepreneurial companies that are doing a lot of the growth in the country. I want you to be in the new companies that are doing all of the innovations. This is exactly what you ought to be doing. So broader, the better. Buy an index fund. You want to go and buy some individual stocks around the edges? God bless you. Go do it. But you can do it far more safely if the core of your portfolio is indexed. And look, I buy individual stocks, but I can do so because my SEP IRA, my 403B is entirely indexed.
I don't know. I always say, first of all, I think you're right. I think Jeremy Siegel's right. I buy and hold it forever. To buy and hold it forever. All right, folks, just buy and hold it forever. You're buying America, and it'll pay off. You'll have your downturns, but on the whole, the returns are good. You think the stock market right now is a little expensive, don't you? I know you're not short-term call, but in the last minute.
I do think it's a little expensive now. But but there's another good thing about the idea of people saving for retirement in the stock market, and that is that they can do what's called dollar cost averaging. Yes. I've got various tables in my book. Suppose you were able to put $100 a month into the stock market. Some of the time the stock market's going to be, quote, overvalued. It'll be too high. But in other times, it'll be too low. And the good thing about this so-called dollar cost averaging is you buy more shares when the price is low. And therefore, your average is going to be helped because on average, the price you pay is less than the average of the prices in the market because you're buying more shares when prices are low. And I've done some calculations.
I agree. I got to jump out. I got to go.
Even in a 10-year period, when the market didn't go up, you can make money by dollar cost averaging.
Princeton Emeritus Professor Burton Malkiel, 50 years, Random Walk on Wall Street. It's just as good advice today as ever. Thank you, Bert. We really appreciate it.